If you ask most Americans how the economy feels right now, you'll hear the same word over and over again: uncertain. Not collapsing, not booming, just uncertain. People are still going to work, still paying bills, still buying groceries, but something feels off. Prices remain high, debt feels heavier than ever, and confidence is fragile. What makes this moment unusual is not what people see, but what's happening quietly underneath the surface. Today, the United States received new inflation data, and for the first time in a while, it told a slightly different story. Inflation came in lower than economists expected. On paper, that might look like a small technical detail. In real life, it carries emotional weight. Inflation is not just a statistic. It's the stress people feel when they check their bank accounts, when rent goes up again, when groceries cost more than they did last month. When inflation slows, even marginally, it signals that pressure might finally be easing. This matters because inflation has been the dominant force shaping everyday American life for years now. It has changed how families budget, how businesses plan, and how much risk people are willing to take. Lower inflation doesn't fix everything overnight, but it shifts the direction of the conversation. Instead of asking how much worse things might get, people begin asking when relief might arrive. And that question immediately leads to the Federal Reserve. The Federal Reserve sits at the center of this entire system. Its decisions influence borrowing, saving, investing, and spending across the country. When inflation runs hot, the Fed raises interest rates to cool things down. That's exactly what happened over the past few years. Rates climbed fast, and the effects were felt everywhere. Mortgages doubled, credit card debt became suffocating. Auto loans turned into long-term commitments many people regretted signing. Now, with inflation showing signs of slowing, attention shifts. People begin wondering whether the Fed can finally loosen its grip. Lower interest rates would mean cheaper borrowing. It would mean breathing room for households stretched thin by debt. It would mean businesses feeling confident enough to invest and hire again. Even the idea of rate cuts can change behavior before they actually happen. But this moment isn't just about inflation data, it's about timing. As the year comes to a close, the financial system enters one of its most sensitive periods. Banks adjust balance sheets. Institutions settle accounts. Liquidity tightens. This is when stress can quietly build without warning. History shows that many financial problems don't start with dramatic crashes. They start with small disruptions that compound quickly. That's why the Federal Reserve didn't wait for problems to appear today. Instead, it acted quietly. It injected liquidity into the system, ensuring banks had enough cash to operate smoothly through year-end pressures. There were no dramatic headlines, no emergency language. And that's by design. Stability works best when it goes unnoticed. For most Americans, this activity is invisible, but it matters deeply. It's the difference between a functioning system and one that freezes under pressure. When people swipe their cards, transfer money, or withdraw cash, they rarely think about the complex machinery behind those actions. That machinery needs constant maintenance, especially during moments of transition. What makes today especially interesting is that these quiet financial actions happened alongside a very public political signal. President Donald Trump made comments today about the future direction of the Federal Reserve. He stated that the next Fed chair should strongly believe in much lower interest rates. That single statement introduced a new layer of tension into an already delicate situation. The Federal Reserve is designed to operate independently from political pressure. That independence is intentional. Monetary policy requires long-term thinking, even when the short-term consequences are uncomfortable. Lower interest rates can stimulate growth and make life easier for borrowers, but they also risk reigniting inflation if used too aggressively. When political leaders weigh in on central bank policy, markets pay attention, not because a decision has been made, but because expectations begin to shift. Markets are forward-looking. They react not just to actions, but to signals. A change in tone can move billions of dollars before a single policy is implemented. This creates a complex environment. Inflation is easing, but not defeated. The Federal Reserve is stabilizing the system, but remains cautious. Political pressure for faster relief is growing. None of these forces alone defines the future. Together, they suggest the economy is approaching a crossroads. For ordinary Americans, this moment is confusing. Many people feel